Well, it's also see me from here. How you guys doing? Hi, Craig. How you doing? Like I said, Deepak and Dan. Welcome. So, since you guys have a mic, I also prefer if to be more dynamic. Feel free to ask any questions. Okay. So, should be able to see my screen right now. Which chart do you see here? Do you see the where it says Euro Japanese yen?
Yes.
Perfect. Okay, so okay, so I don't know what your level is when it comes to technical analysis. As a trader, we've been trading now for 23 years, 23, 24 years. We've seen basically different charts from top to bottom. But the major one I basically got is how to read price. So I believe price is everything. And at the same time, going through the trading floor just to really see the mechanics of the way how price is and being translated to a chart makes it easier actually for me as a technical analyst and as a trader. Price patterns, when I basically learned it, automatic, what the people would say would be a form of reversal, like say for example, like this one. This is a price pattern, also known as a morning star. So people will always say it is a reversal pattern in terms of price heading to the upside, but not necessarily. The majority of the time, it won't do that. And as you can see, it is actually heading back down. And the reason being, Morningstar patterns are also what we call correctional patterns. In most cases, a lot of patterns are correctional patterns depending on the way how your knowledge in regards to supply and demand and price in general. I also add in fundamental analysis, mainly the macro global economy, since I trade currencies and futures. I don't trade stocks anymore. The reason being is because of the manipulation of the markets, not much liquidity, and I don't like the gapping, especially if you are more of a short-term trading. Investing, on the other hand, if you're doing long-term, then shorter term doesn't really matter, right? So because you're dealing more of a bigger time frame. So what we'll be dealing today are a couple of things. One is simply, we're also going to discuss what we call multiple time frame analysis. And we're also going to discuss in regards to some science behind it in terms of Newton's laws. So I don't know if you could remember your physics, but I'm going to go through a little bit when it comes to that. We're also going to discuss about supply and demand and how trends operate based on supply and demand. And last but not least, everything is all about price. One of the major challenges or major issues actually when it comes to learning technical analysis is simply a lot of retail traders are based on what we call pattern recognition traders, or they will look into patterns and they will just enter for the sake of entering without actually fully understanding behind the mechanics or the mechanics behind the patterns and based on what they're trading. And then they add in different type of indicators. The next thing you know, there's a lot of confusion, technical in terms of analysis paralysis and hesitation. So we're also going to deal about the psychology behind trading, because at the end of the day, trading is actually pretty easy when it comes to technical analysis, but where it's also challenging is simply the emotional component of what traders have. Not everybody will have the same behavior, not everybody will have the same emotion. So if a person is more of dealing a lot of anxiety, they will micromanage the account definitely for sure, especially for short-term trading. Short-term trading also a lot of disadvantages, especially when it comes to emotionality. Long-term trading, same thing. If the person is very, very anxious, they will micromanage the account without following the plan. So they'll go hand in hand, hence the mental game and the technical game. Plus, you have the physical component as well in terms of health that will create the performance when it comes to trading. So in other words, if a person doesn't eat right, or a person is dehydrated, the brain couldn't function when that happens. And the person starts to have headaches. That will also create some form of emotionality based on the physical aspect too. And so the physical to the mental with the technical component. So these are the three types of conditioning, in my opinion. If you want to make money in the marketplace consistently, all three has to be in alignment. So when all three are in alignment, then you are in zone. So mental, physical, and technical, they all go hand in hand, right? All right, so let's, do you have any questions when it comes to this? This is basically just an introductory, right? Okay, any questions? If not, then let's go through. All right, quick questions. In order for me just to understand where you guys are coming from. What are the two components when it comes to technical analysis? So the question would be is, what are the two components of technical analysis? So if you're looking at a chart, what are the two components that defines a chart based on technical analysis? If you have a mic, please feel free to state your answer, but if not, you can also type it in the chat box. What would be, do you think, Deepak? What are the two components of technical analysis? If you're based on a chart, what are the two components that is very important? That defines a chart. Craig, Van, or Nick? Welcome, Nick. So what are the two components of technical analysis? Any idea? Don't worry, there's no right or wrong answer. Okay, no worries. Thanks, Craig. Okay, yeah, no problem. Actually, your mic's been muted, but your computer will always have a mic if you're using a computer, but if desktop, then maybe not. Trends, volume, so these are factors of types of indicator. Trend defines simply the direction of price. So if you're looking at a chart, you have an x-axis and a y-axis, right? So x-axis, so simply is price and time. These are the two components or factor of variables, whatever you call it, depending on the way how you see it when it comes to technical analysis. It doesn't matter what you use. A chart is a chart, and it doesn't also really matter what vehicle you trade. Either you trade currencies, you trade futures, you trade stocks. These are the two components. So there's another component, a third component, which is actually very, very important when it comes to technical analysis. So that would be, and by the way, that's why I'm going back just to as a form of review, because it's actually really imperative to really understand this concept. So when you're trading, you have an empty canvas right here. There's a big question mark. So the question is, where is the direction of price when you're trading, where it's going to go? There's only have three different directions, right? It will only go up, it will go sideways, and it'll go down. That's basically it. So if you have three different directions, then the third component is distance. Distance is an important element to calculate the time when it's going to arrive with the approximation of where the price is going to be. Price, time, and distance. So these three aspects is a very important element. At the same time, when you're trading, it is imperative to define what technical analysis is. As an analyst, technical analysis is simply defined as the study of price movement or price action, or in other words, price, to forecast future price movement or price action using present and past data. So to forecast the price somewhere sometime in the future, you need the data. You need the current, which is the present, and using past data, which is basically all the numbers involved, to create that probability. So in other words, it's all about statistics. So when you're forecasting based on probability of winning, it is imperative for you as a trader, as an investor, to define the probability. When you have that, then you're being objective. See, the issue of retail trading or retail traders is that they use subjectivity. What do I mean by that? They will use words such as, it looks like, I think it is going to go up, without any evidence to claim why they're going to buy or why they're going to sell. When that happens, and you want to be very careful, is that when you're using subjectivity and you're using based on your own perception, your own way of thinking, then you're screwed. It's simply, you're just gambling. It's a 50-50 chance. Now, if you can find the probability, mind you, mathematically. So if you haven't met me, my background is physics and mathematics, and then computer science and mathematics. This was, I graduated actually in 1993. That was my first one. It was physics and mathematics, and then 96 from computer science degree in mathematics. And I never knew that I'm actually going to be trading. So when I graduated, I worked as a systems analyst back in Australia. That's where I grew up. And one of my workmates started trading stocks, buying the paper. Mind you, computers didn't really, like in terms of internet, wasn't as fast or popular like what it is today. So everything was all using paper. I used to actually using a graphing paper and plotting price when I basically first started as well. And so that's how it all began in terms of my journey trading. 2002, I left work, my career as a database administrator, and I became a full-time trader ever since then, and never looked back ever since then. So I've been a full-time trader now for 17 years, but I started trading in 1996. So this is my 23rd year actually of trading. So it took for me 6 years in order to work something and then to leave work to be a full-time trader. So I'm not by the way, a disclaimer, I'm not here to give you any formal advice. I'm here to give you a piece of information and just to help you understand purely about technical analysis in its purest form and how price is actually, patterns are being formed through price. And then can you at least would be able to get in at a good price point where it's at wholesale rather than at retail. Because when you're getting at retail price point, when you're now dealing with comes to risk, your risk management becomes now huge. But if you can buy in where approximately where institutions are buying, then your risk is now very low and your probability of winning is actually more higher. So statistically, mathematically, if you're into numbers, even before you even place in a trade, you're already up 33% because price will only go in 3 different directions, nothing else. It will go up, it will go sideways, or it will go down. So if at the starting point starts at 33%, then you have a deficit of 66%. In my opinion, 66% of using technical analysis is not enough. Wall Street Journal actually wrote a report like 5 years ago in regards to, or this was 2008, 2009, yeah, 2010 actually, yeah, 8 to 10 years ago, about, of course, this is now almost a decade, probably statistically already changed, but statistically wise, they have found that the success rate of a retail trader is around 55 to 56%. And it's very interesting that it's a 50-50 chance. Yes. When you're now making a claim, whether you're going to buy or sell, then it cuts down. Holding is no longer applicable, right? So either you buy or sell, then it becomes now 50-50. So, but how can you increase your 50% of winning? So based on the 66% deficit from a starting point, this is where your work is going to be meticulously. When I say meticulously, as a trader, you need to know in and out from top to bottom. You need to find evidence on why you have to enter. So if you can define that in terms of the evidence of why you're entering based on price, so what are the questions, what are the pieces of information that you need in order to find that evidence? Also, what are the evidence based on your technical analysis in terms of your skill set to increase the probability from 33% beyond 55 and so forth? My rule is that if it's below 80 or 75, I won't place a trade. So it's like playing cards, right? If you have a royal flush, then bingo. You don't even hesitate. You just have to enter. It's just a matter of your risk management on how much you're willing to put in regards to your position size. Now, if you have a straight flush, maybe that's a 90%, right? Because there's still a probability that the house will win. Mind you, though, the difference between trading and playing cards is that you're playing cards, you know exactly that there's going to be 52 cards in one deck. When you're trading the markets, regardless, we're trading stocks, futures, currencies, with the exception of options, you have an infinite card. Why? Because we as retail traders do not have the piece of information what institutions have. Plus, we cannot have any control when it comes to natural disasters like earthquakes, typhoon that will affect basically the marketplace. Also, we don't have the piece of information of maybe perhaps terrorism will start to happen, or Trump will say whatever, or Powell will say something like what happened yesterday. Notice the markets actually went to the roof, then all of a sudden, bam, after FOMC, they had the conference, markets basically tanked, the VIX went up, the dollar basically went to the roof, and major currencies also basically dropped, right? So these are the factors that you and I have no control. What we can do is just to react in the marketplace. That's our job. But you as a trader now, if you are based on your perception that you think that you can beat them, forget it. Odds and probability that you're not going to make money or be in this game for that long is very slim, to be honest. Okay, so if you've been trading more than full-time, more than 3 years, congratulations. That means that you're doing something right. Now, if you're trading part-time and also you're making money more than 3 to 4 years, congratulations, then you're doing exceptionally well. Then, in my opinion, I would suggest to keep on doing whatever you're doing and to keep mastering based on what you're doing. Now, in my opinion, learning, I always learn from the markets. I also learn from people. I learn from students based on mistakes. And this is what makes us excel and to be masterful at something. I've done probably, I don't know how many hours of looking at charts, also going to the trading floor when it used to be when people you can go in. Right now, not anymore because everything is all algorithm based. By the way, now that everything is all computerized and algorithm, it is mainly more challenging actually to day trade. I do not believe in day trading, to be honest, unless your server or you're trading close to the trading floor. If your server is close to the exchange, excellent. Other than that, if you're a retail trader and you're using TD Ameritrade, E-Trade, and you want to day trade, no, it wouldn't work. It's too late, too slow, right? Also, a lot of traders want to create, retail traders I'm talking, automated systems. It wouldn't work either, right? If you want to compete against the marketplace, their algorithms are totally different. It's so fast and so quick. It goes in faster than a millisecond. So, and I've seen it. You know, I know a trading firm in Chicago. They have a very high success rate, 90 to 92% when it comes to algorithmic type of trading. So that's why I don't deal with short term. Yes, at the end of the day, to be honest with you, I would rather trade just 1 hour a day, looking at the daily time frame or 4 hourly time frame to define, and I'm just letting it be, letting it ride, be with the wave. So when you're with the wave, like say when the wave is from this component, then just let it ride. Then you'll make more money with less stress rather than day trading. That's just me, of course. Okay, so these are the things in terms of components that I'm just basically discussing with you on why technical analysis is easy yet also challenging. But everything, in my opinion, is all about numbers. Numbers never lie. Mathematics, you need to be good at basic math, or at least also need to know to measure your probability. Once you have all the tools, it becomes easier to measure your probability. And it's like, yeah, measuring one's probability is very subjective unless it's in a group setting where everybody will create a probability. You take the average, right? So that becomes more objective. If you're trading by yourself, then it is really up to you based on your skill sets and your knowledge to create that probability. But the evidence only purely based on technical analysis, in my opinion, is not enough. That's why it's important to look at the fundamentals that could push your claim on why you have to enter. All right, so let me move forward basically from here. The other one is when the other thing that we have to discuss when dealing with price will be based on news, whether you like it or not. With no news, there's no price. Price will go up or will go down. But the thing is, what is the mechanics behind that goes up or down? Well, there is a buyer, there is a seller. So if there is a buyer and there is a seller and they're defining their buying and selling based on news, which now they have to buy through price, it involves some form of emotion, either positively or negatively. So that emotion creates demand versus supply. So if it's great news, and if the thought process of people who are buying, especially, just imagine this on the trading floor. Trading floors, it's simply institutional type of trading. In the past, unless you have some form of money, then you can trade at the trading floor as an individual, as a retailer. And easier for that to happen because you can see who you're dealing with. You can see who the institutional traders are. Now, when you're using a two-dimensional chart, you don't know who you're dealing with. That's why a lot of retail traders will guess. It's a guessing game. You do not want to guess. I do not want to guess. So to really know where institutions are buying or selling is simply purely at the cheapest price possible. the high price, or when you're dealing also with price, you have an open price, high price, low price, closing price. The high, low, and the close, these are all institutional price points. Why? Because even if we combine all our money together, we won't be able to hold a price. There has to be some form of amount of stocks, amounts of future contracts, amount of currency contracts in order to hold the high price or the low price. Closing price cannot be dictated by a retailer. It can only be dictated by an institution in the trading floor. That's why those three price points are very, very important. And these are the three things that I always look at. I don't bother the opening price, because opening price is why if you go through your trading stocks, there's always going to be a fair value. That fair value will be an approximation of an average price of the opening price of the S&P, the Dow, or Apple stocks, Google, or whatnot, right? So they are simply retail price points. Some trades that didn't go through the previous day will be pushed in through the opening. So, and mind you, there's also the futures price that the market will look at globally, that creates also the fair value of that future, right? So like the E-minis, for example, there's a future price for that. Coca-Cola is one of, say, the major stocks that is currently being like drank everywhere, basically globally. So it's why the company itself is also being traded globally. That's why there's going to be a futures price for that. So that being said, if news will be affected, and what are these type of news? Like yesterday, FOMC, that's one of the major ones that we look at. Tomorrow being Friday, you have non-farm payroll, something that also need to look at. Unemployment rate, interest rate component, right? Trump, CPI, Consumer Price Index, PPI, Purchasing Price Index. By looking at all these type of news, let me show it to you here. So Friday, see, you have hourly earnings, non-farm employment change, unemployment rate, and these are the numbers that also you as a trader need to look at. That's your job as a trader, as an analyst. So as an analyst, if you're analyzing and you are looking into that, mind you, all these numbers, those forecasted price points, have already also been released. That's why even before the news will happen, that news has already been released, a piece of information to key people, right? It's not by design that it's going to happen there and then. There's no way. So if that report has already been spat out to major key people, then they already know what to do with it. And whether you like it or not, we live in a capitalistic world here, that if you really want to trade, you need to know all these things, right? So that being said, if news will define price, whether it's good or bad. So the question now is, if it's great news and an institution that sees it as a good buy, everybody will follow. That creates now demand, that price will go up. If an institution sees it as not a good buy, it will start to sell and everybody follows. Then there's no more supply, then price will basically drop. Very important in terms of the mechanics on how price is being created through buying and selling, that create an emotion to create the demand and supply. Any questions? Yes, Craig, it is currently being recorded, and I'll be posting it basically on my blog, and just basically watch out for that one. Okay, no problem. Thank you for coming, Craig. So this, in terms of the mechanics of technical analysis, is very important to know. That's why, Deepak, if you're doing fundamental analysis, and the reason why you're doing the fundamentals is to really support that claim as well based on that price. So if you can have that, then it adds in. And you know why Warren Buffett is so good in terms of choosing stocks is because he knows what type of news or piece of information that could affect the price in the long run based on his probability statistically. So when I got all this, my success rate in terms of winning actually increased. The only time that I will lose is that if I'm not really being meticulous in terms of why I have to buy or sell. When I start doing that, I'm using my own perception and there's no longer the evidence. That's where I start to lose, right? So likewise, for this type of trading, mind you, we haven't even discussed about indicators. Maybe perhaps we'll do that some other time. But now I'm going to show you exactly how price patterns are being formed. So make it this way. Let's discuss, since you know about supply and demand, and discuss in terms of that. I will move this across. And start basically from here. Mind you, by the way, when price reaches from a demand all the way to a supply, and if there's a historical data in the past, so like for example, let me take this one. So the price basically tanked and it came back up and it's finding key price points in the past where this area used to be demand, but because of instantaneous news, euro against Japanese basically tanked, and actually there's no gap in there. This is a data error, and hence that's why I don't do automated trading, because this could happen. So, but nevertheless, it dropped massively from 129 all the way down to 119. In the currency markets, that's 1,000 pips. That's like 1,000 points. That's huge. And then simply went back up to find certain price point back to the 127, 127.50, which that used to be demand, and this becomes now supply. Okay, so when price approaches supply, and if you are a buyer and you know that in the past it's been dropping and now it's basically at to say 127.50, will you really buy it when something is dropping? The answer is no, and the reason being is that it's too expensive. So when something is too expensive and retailers still believe that it's going up, institutions on the other hand saying, no, it's too expensive, I'm going to start to sell. So this is when they start to sell. Notice that they gave everything back away from all the buying area right here becomes now all selling pressure to the downside. So when they start to sell, then that means that there's there's more supply than demand. Notice when it comes to your transaction of the amount of volume, it is slowly basically from an increase to starting to decrease. Fortunately, when it comes to volume, you don't know who's buying, who's selling, or the amount of demand or supply. The only demand or supply you can see is based on the chart right there on the candle. Plus, it is also defined speed. What is speed? Speed is the acceleration of price. When there's too much acceleration, then that now means that buying is no longer there, right? Buyers will disappear. When buyers disappear and selling pressure starts to happen, so imagine the amount of gapping that is coming. So and that's why price will start to go really, really quickly to the downside, like this one, right? That automatically means then that when there's a lot of thought processes of no demand, but there's supply, and they believe that the valuation of a certain asset class is not worth it, that's when price starts to drop until it will find from a supply to a demand. See right here, there's an area of demand, and it will stabilize itself. That's why dojis are being formed. What is a doji? Simply, if you're dealing here with buying and selling, is when a buyer is in equilibrium or equivalent to a seller. The reason being is because they don't know where to go. if you know your physics, if you can still remember Newton's laws, it is a form of inertia. When there's no movement, no volatility, there's no movement. No buying, no selling, and hence it's equal in terms of its equilibrium. Trying to stabilize a price point, and then from there, they will either create a correction, so the price will either rebound or it will continue to drop based on that momentum of price. That's basically what it normally does. So the lows are also a very important element to look at, because if the lows are higher compared to the previous lows, which now you have a higher low, then the odds and probability that it will rebound to create some form of a correction is highly probable. Hence, law of harmonic vibration is simply the oscillation of price. Price has to correct itself, what we call impulsion. It will create an impulse like a heartbeat, and it will correct itself, impulsion, correction, and a continuation of the impulse. Since everything is pure energy, like you and I, as human beings, we are pure energy. We have a heartbeat. Toot, 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 toot. And if you exert force, your heartbeat goes faster. Likewise, in the marketplace, when there's a lot of work, acceleration will increase, and everything you see fit inside has a lot of energy vibration. Every candle has an energy vibration. So when price accelerates, so mind you, from in form of inertia, Newton's law, second law, dictates that it creates force. Force equals ma. But when there is an outside force pushing the other force, which is now the inertia, then it will create some form of movement. Mass times acceleration. Mass is simply the volume times the speed of price to the upside or to the downside. Like this one has a lot of force. See, look at that. You can calculate its force mathematically based on its science. So mind you, I'm now talking here advanced technical analysis. So when there's a lot of momentum and a lot of movement, it will stabilize itself again, either one, it will continuation or a correction. But notice, because of this movement, you have a bunch of lower lows. Then the odds and probability that once it reaches supply, you have to sell because it is trending to the downside. You cannot go against a trend. You cannot sell at demand. You cannot buy at supply. You will lose. Your risk is going to be very high. And that now means you are now against the law of supply and demand. Very important to know, right? Okay, so those are the basics in regards to supply and demand and trends that creates higher lows here, lower highs. And the next process is simply a lower low. See here, all the bunch right there, you have a bunch of lower highs. And somewhere, sometime, they have to create some form of a lower low. But because of this, can they retest that somewhere, sometime in the future? Absolutely, but that will take time. Okay, so that's where the fundamentals are coming in terms of the basic fundamentals of technical analysis. So here, let me go to where we are at. Boom. And we'll just show you exactly how price patterns now are being formed, such as morning stars. So that being said, when price approaches supply and it starts to drop again, then they will find a demand point. So based on supply and demand, by the way, you have supply, you have demand, you have equilibrium, hence a 50-50. That's why if part of your trading you're using moving averages, moving average is simply the average, it is the midpoint. It's a 50-50. So that's part of the equilibrium. And as long as the price is above that equilibrium point, then it will continue its trend to the upside. So moving averages are trending indicators. That's simply the whole purpose of moving averages, right? So here, price is at demand. You have a lot of force. Notice in terms of the volume, however, volume is actually decreasing. When volume is decreasing, then now it also means that it's oversold. It is getting to an area of getting oversold. So if the last low price is at 123.66 and is approaching 123.66, the question now is, can they break that? Can they break this area of demand? It takes a lot of power in order to break it. Why? Because how many times in the past that every time it reaches 124, it rebounds to the upside? Numerous times. 1, 2, 3, 4, 5, 6, 7, 8. Then doesn't want to. 8. Currently approaching its ninth time. 9 times. So what are the odds that it will rebound? Highly probable. But just because also it's a bearish candle doesn't necessarily mean that you have to sell. I guarantee you 100% that if I'm gonna ask traders, retail traders, that you have this at this point in time, will you buy, sell, or hold? The majority of the answers that I'm going to get is I'm going to sell. No, you will never sell at a level of demand. You will only sell when the demand has been broken. That's the rule. The odds and probability that each and every time when price approaches demand, it will stabilize itself, hence some form of a doji will form. When the doji forms, stability, the next portion from here is a correctional component or a continuation of the price to the downside, which is Newton's law number 2. Newton's law number 3 is an equal and opposite reaction, right? That's what the market simply does, is simply when there's a lot of force, it will stabilize itself, correct. So let me draw. That's what trends are for. It will drop, it will stabilize, it will correct. It will stabilize, it will continue, it will stabilize, it will correct, it will stabilize, it will continue. That's how oscillations and trends are being formed. To the upside is also the same. That's why it's oscillating to a certain degree, to a certain point. But here, everything is here is just one movement. So that being said, if stability will form, then the next part would either be a bullish candle or a bearish candle or another doji. That's basically it. So since price is at demand, will I buy? Absolutely. Why? Because my risk is very little. Can I do a test trade? Definitely, for sure. So buying at demand is a very critical rule as a trader. I will never buy at supply. So from here, what can I do in order for me to get, or also some form of certainty that it will continue to go to the upside? Since I have a lower low, but I do not have a higher low. Notice it did form a higher low. So I'll go through here on a smaller time frame and show you that this doji is this movement right here. Opens at 1700, closes at 1700. So this is the currency market. Opens at 5 in the afternoon, closes at 5 in the afternoon. It's a 24-hour, 5 days a week. And this is one of the advantages why I love trading currencies, and this is all why I teach traders using currency markets, is because of that element. It's easier to teach someone when the market is actually live and it's actually moving compared when it's closed. So this one, it went up, it went back down. That caused to create the doji. So notice this higher low was formed based on this candle that created this higher low right here. Let me try it so you can see. Higher low is the same equivalence as this higher low. Okay, very important to know. So I use a technique that basically I developed what we call the sequential transitioning system. It is a system based on transitions. So you're entering before anybody else, because it's a sequence. The market creates sequences like numbers 1, 2, 3, 4. The number can go from 1 to 3 to 5. It has to go from an odd to an even to an odd to an even. So 1, 2, 3, 4, 1, 2, 3, 4 to create a sequence to define what we call trends. So that being said, that if a higher low will be formed, then where is the last high that was formed in this component? Well, the last high that was formed was not even here. There's nothing, only there. But the sequence from here to here, technically, we also define minor and major highs and lows. So this is your minor high based on the last. And that means that if I'm entering here, the odds they will break this high is highly probable. Did it? Absolutely. After 2 candles, it broke to that high. So from entering here, that's approximately oops. Sorry. 32 pips, that's 32 points. So that's not too bad in a span of 8 hours. And you actually even went beyond that, going through 57 pips in a span of 1, 2, 3, 4, 5, 20 hours. Okay, so let me go back. Yeah, sorry guys. Okay, so that being now translated, let me just erase. So if that's been translated and the higher has been translated, then how about this bullish candle? Well, this bullish candle where it closed at 124.99, 124.99, 1700 hours. This low should be 124.99 as well. Close 124.98.7. Am I on the bid? It's also based on the ask, control ask. 429, 24.996. 24.996. Yep, there it is, 24.996. Okay, so with that is that bullish candle from 1, 2, 3, 4, 5, 6, 7 times 4. Yeah, 23, 24. 7, 6 actually. 6 times 4, 24. 24 hours. So yeah, here it is. Close 24.96. Sorry, yeah. 1, 2, 3, 4, 5, 6. 24 hours. This was the bullish candle that now formed your morning star pattern. But notice though, and here to prove to you why morning star patterns are simply just sometimes a correctional pattern only if it's a lower low. Okay, that's the condition of it. So during my annotation tool 1, 2. So if I form high to the low based on if you're using your fib, bingo, 38, 50 percentile. That's to show that Morningstar patterns are correctional patterns from the last impulse off. This one is a minor impulse, but if I'm dealing here with the major one, if I use another fib from there to there, 38.2 percentile. So in order for a Morningstar pattern to work, I would need another higher low somewhere, sometime in the future. And that's why this one failed. It didn't want to continue. It's because it's correcting from this impulsion and this impulsion, that you need a proper, another higher low in order for this to actually continue to go to the upside. Despite there's a higher low over here, because such a movement, and based on news, it needs to create another higher low before it can continue its either trend to create another lower high or a new higher high somewhere sometime in the future. But because this one creates a new higher low, based on this, the odds and probability to break this high, which is now 126.81, is highly probable somewhere sometime in the long run. Okay, so moving here, clear all my drawings. So I'll show you what it would look like. 1, 2, 3, 4. 1, 2, 3. It has to go through number 4 here to create from a higher low to now a new higher high. So when it comes to distance, is this a good buy? Absolutely. Can you get a better price point of buying? Yes, currently is a better price point of buying because the price is now closer to that compared to here. Look, you're in a supply where here is a demand. So there's a distance when you're dealing now with risk. If you're buying here, you have 67 pips or point difference. What if you're putting your stop below the low? Then you are now 120, actually you say 100 pips behind. Now that the price dropped, rather than 100 pips, it's 50, you have a 50% discount. So now the price is back, getting closer to demand, you have a better price point and higher probability that if this one continues now, remember we're talking about distance, if it goes beyond number 2, then you have at least 239 to 240 pips in terms of profitability to risk 50. You have a 6-to-1 reward to risk ratio in a span of the whole month, so probably 10 trading days, okay, to get up in there. Of course, time is a factor. When time is a factor, the longer the time frame, guess what is involved in terms of value? Patience. To get price here, you need patience. This is your distance. This is your profitability. That's why you, there's also a mathematic component that I use as a technique to know approximation of where it can go, and you just have to let it ride, basically. Of course, there's certain elements, part of the patience, focus is also involved, and of course, last but not the least is you need the discipline. Oh yeah, and the integrity to do so. But there's one thing that intuition is something I cannot teach a trader. I can give a process how to increase the intuitiveness through meditation, but it's up to the individual to also follow the intuitive process through there. Okay, so integrity. So we're doing here now about psychology. That's a different topic once again. Okay, so that's how price patterns are being formed, from our price patterns being formed like the morning star. Evening star is the same process. One, after a very bearish candle when there's a lot of force, The next step for it is it has to create some form of stability, some form of doji. That's number 2. Number 3, if it chooses to be bullish, it will create now a morning star using smaller time frames, or what we call multiple time frame analysis, where you can actually see it, and you can dictate them by buying close to an institutional price point, basically from there, and then using what you call a sequential transition system from there. Okay, and then from that, as if it doesn't want to play like this one, form of stability, most cases you got to get out, because if it's really bullish, and if that Morningstar patterns, especially if the third candle is a decision making process after very bearish, and all of a sudden the bulls did come in other words, buying or demand comes into play, where sellers are now in control, dictating the price, because they know that the valuation of a certain asset class is cheap, and it's up to them to dictate the price. You want it, and you know it's in demand, then you can get a higher price. But if they choose in some form of stability, either you get out, close your account, or take your money and run, or you hold it until you get tapped out. So these are the rules that you can basically create. You can also discuss some other times, say like here you have a bullish candle, then you have a correctional one before a continuation. So these are all techniques simply being used, or what I use now that I fully understand how price is currently working. And I'm not even using any form of indicator yet, right? Because indicators also go in hierarchy. And so indicators are also really good tools. There's certain tools, indicators that can add into your probability of winning. But today, my job is just to show you and share with you a technical tip in terms of how price patterns are being formed from a very bearish candle or price dropping rapidly to a stabilization to a correction, and then basically the question is where to from there. Okay, so do you have any questions? Was that interesting to you guys? Did you learn something? Was it too advanced? I don't know. Maybe you already know this. Any feedback? Deepak, if you're still there.
Yeah, so I think it was very interesting, especially where you mentioned that we have to be objective with the probabilities. So my question really is how do we really achieve that with probabilities? Too deep into statistics to kind of estimate the probabilities, or is it a little bit easier than that?
Yeah, so to create a probability, so for me there's a few processes, right? I look at the macros, that's one of them. Two, I look at the location or the position of price. Location of price, where is it at? Is it a level of demand or supply? So you need to define that. Three is about the trend. Four, I need to find the news aspect that could affect the price. So last base of that is price. And then you can add in more into that is simply the use of other indicators. So 1, 2, 3, 4, 5. So if I can have all these, then if I can equate to that, then I can create, say, from a 33%, and these are the 66% in terms of deficit. Oh yeah, other indicators such as what I could call my sequential transitioning system. Like say this one, I have a higher low. That to me is a highly probable, like it's almost, I would say, like a royal flush to me, or a royal flush trade, because the potentiality, when you say potentiality, the probability that it has to form a higher high somewhere sometime in the future is highly probable, but at least I know where the distance or where it can potentially go. So if I'm not being greedy, if say for argument's sake, let's discuss about 2 points, point A to point B. Point A is your house, point B is your work. And say your car, for argument's sake, only has 10 miles left remaining. If you have a brand new car, then to get to work is 15 miles. Then for sure you need to put, say 7 miles is halfway, you have 10 miles, you won't be able to make it to work, right, Deepak? Then that means somewhere here you have to put gas, or else you run out of gas. So you can measure by you defining, oh, okay, I only have 10 miles left, I'm running out of gas, it takes 15 miles to get to work, I need to find a place specifically within this distance where I can put gas. If not, I won't be able to make it. Same thing in trading the markets. The question is, which ones are there in terms of your gas tank that you can put in order for you to place a trade? So the position sizing, once you can create that probability, then you will know automatically the amount of position size you're going to place based on your amount of risk you're willing to take. So in other words, if I know, let's say for argument's sake, this one is a royal flush trade for me, then I will put the maximum risk that I would be able to risk in terms of my capital. My rule is 10%. So part of that 10% is simply this component. Can it come back down? For sure. Am I going to be okay with it? Well, I should be, because if the point of entry from the stop loss point is that I'm willing to risk 10%, then I should be okay. Then if I micromanage the account, then that means I didn't do my job properly, then automatically I'm not really willing to risk 10%. See how the dynamics already change? So, but to answer your question, Deepak, these are the major ones, the tools to measure one's probability.
Got it. Okay, thank you for that. I have another quick question, and I don't know if you might have mentioned it earlier to different people, but is there a good book for technical analysis?
To be honest with you, there is not one that I basically know. They will tell you like the patterns, but some of them they don't explain fully behind what's happening. The closest one will be Steve Nissen's book.
Sorry, say that one more time, please.
Probably the best one that I would recommend is Steve Nissen.
Steve Mason?
Yeah. He writes about candlesticks.
Okay. And do you know the title of the book?
There is a introductory to technical analysis.
Okay.
One second. It's also called the Candlestick Course.
Sorry, Candlestick what?
Course.
Course, okay.
Yes. Okay.
Thank you.
You're welcome. And if you need to know more, well, I also sell basically there's a beginner course that deals with everything in terms of price. So that is also another element that you could look at. It's all video based. It's either that, if you want one-on-ones, I also do that one. But other than that, yeah, if you're interested, I'm more than happy to give you that piece of information there, Deepak. Alrighty, guys.
Thank you.
You're welcome. Well, I hope that helped you once again, that it becomes a little more clear. And if you have any questions, please feel free to email me. And yeah, I will send out the video recording. You can watch it again. Have a good day. See you guys.
Thanks. Thank you so much. Bye.
Bye.